Hello, my name is Greg Michalowski. I'm the Director of Client Education and Technical Analysis for ForexLive.com. In this video, I'm going to talk about the 5 smartest words retail traders say. I like to think that I'm a more optimistic person, or at least I think more positively about things. For example, I don't like certain words. I don't use the word hate. I could easily have said, I hate certain words. Instead, I said, I don't like certain words. It's a nuance, but I think it's an important one. I don't like the word stupid. For anyone who has read my book, Attacking Currency Trends, you know I like to keep trading simple. That works closely with the KISS principle, which to most people is keep it simple, stupid. A seminar friend of mine once told me instead of keep it simple, stupid, he likes to use keep it simple to be successful. Now that's more like it. It's one of my trading rules, in fact, keep it simple to be successful. I even try to find the positives in him and in her. It's hard to do at times, but I try. In Forex trading, there are a lot of negative things I can say about retail traders. It is easy to criticize, but let's not go there. Instead, I want to focus on the positive. The 5 smartest words retail traders can say and believe are, I care about technical analysis. Now, for some, that may be a shock. There are some who are hearing this and probably wondering, what about fundamental analysis? Isn't that more important? After all, it is the fundamentals that drive the price action. That is what I read in the papers or online. That is what is on the business channels each and every day. It must be important. It is human nature to want to hear the story. Why did the market move here? Why is the market going to move there? It makes us feel smart to know the whys and to try to predict in our crystal ball which way the market is going. Now, all that can be true, but have you ever been caught thinking the wrong way fundamentally? Have you ever had your fundamental story or your basis for a trade change? It is always the fundamental surprises that lead to the strongest trends in the opposite direction of what you thought. Those fundamental trades that go horribly wrong are often the basis for many traders disappearing forever. Traders who were here yesterday may not be hearing this today. And they should be. So why is that? And the reasons are that fundamentals do not define or limit risk. When you put on a trend for those fundamental reasons and the price action goes against you, where do you admit defeat? Most traders don't know. If you don't know, your risk is unlimited. Is that a way to run a business? So for me, fundamentals are a secondary tool in the trader's toolbox, not to belittle them. They are important, but they are not the primary tool. They can provide a bias from your trade. I want to sell because I am bearish for this fundamental reason. I want to buy because I'm bullish for these fundamental reasons. But it is not the trigger to push the button to trade. I need something that will give me a bias and from the price action tell me when I am wrong, because I will be wrong. Technicals do that. So when I hear traders say, I care about technical analysis, those 5 words, I know that they have the potential to use a tool or tools that will define or limit their risk. If they are disciplined to those rules, they will not blow up and disappear forever. Moreover, if they define and limit their risk, they have the potential to risk a little. And if they are not risked or stopped out, they have the potential to make more than a little. That, my friends, is what is most important as a retail trader. So let's look at a few simple examples. In our example, I'm looking at the hourly chart of the New Zealand versus Canada. This is not a mainstream currency pair, but technicals tend to be indiscriminate. If you are using standard technical tools that are used by many, technicals work on any chart. This chart has no technical tools. It just shows the price action. Let's add some tools and see how the vision becomes clearer. I've added the 100 and 200 hour moving average. The 100 hour moving average is the blue line. The 200 hour moving average is the green line. Let's add another tool, a trend line down here, connecting these most recent lows. What do you see at this trend line? I see buyers leaning against the low. By using this simple trend line, this simple line, traders have something to lean against. When they lean, they can define and limit their risk against that line. A trader might buy here and risk this much on the trade. If the price goes below the line and to their risk point, they are risked or stopped out. If the price stays above that line, they are not risked out. The risk is a fraction of the potential reward. Even if the trader exits here by leaning against the 100-hour moving average, that's the blue line, the reward is a multiple of the risk. Traders who care about technicals could have done that trade and made, 30 or 40 pips. If they stayed in the trade and didn't get out at this level, the potential reward was greater, perhaps 70 pips. Not a bad return. What do you see here and here against a 200-hour moving average? Well, I see sellers leaning against the moving average line. Like at the trend line, risk can be defined and limited. Now, who stalls it up here? Well, I know one group who may have stalled it are the buyers from the lower trend line, those ones who are taking profit up here. Others are traders who sell here with risk defined and risk limited. Those traders are simply leaning against a 200-hour moving average with limited risk, just like the traders at the bottom leaned against the trend line. Let's add the Fibonacci retrace from this high, this swing high, to this swing low right here. What do you see here and here? Well, I see sellers leaning against both the 50% and the 200-hour moving average. Sellers now have two reasons to define and limit their risk. Do you need a fundamental reason to do any of these trades? Not really. You should know that there are no scheduled fundamental news when these trades were entered. It was simply price action. It was simply traders using technical tools. Now, what do you see here, where the price moves above the 50% and the 200-hour moving average? I see sellers turning to buyers. I see the price above the moving average line and above the 50% retracement. I see the fundamental bias probably turning more bullish with risk defined and limited against this area. The story changed. The traders' fundamental blogs might say that the New Zealand-Canada moved higher because oil prices moved lower, depressing the value of the Canadian dollar. When the New Zealand versus Canada goes higher, the Canadian dollar is getting weaker. A trader who cares about technicals might simply say, I could define and limit my risk against the level and was not risked out. If the trade was kept on or until the prior high was reached right here, that was worth another 75 pips. No fundamental reason, just some technical reasons. Let's take a look at one more example. This is a more mainstream currency pair, the sterling versus US dollar. And I've already put in things like trend lines and Fibonacci retracements and our moving averages. The blue bar is still the 100-hour moving average, and the green bar represents the 200-hour moving average. But notice right here against the 50% retracement, against the 100-hour moving average, against the trend line that connects these two lows, and against these prior lows and swing highs through here. There's a lot of reasons for the traders to lean against those levels. A lot of reasons where technicals take charge, where risk can be defined and risk be limited. So traders who would buy right here, they would put their stop or risk right here. And if they were right, if they weren't risked out, the price moved higher. And where did that price go? Well, it went back up to this topside yellow area, which also has a number of different swing highs through here. And the market stalls against that level. And what does it do from there? It moves back down and tests that trend line one last time, where again, risk can be defined and risk can be limited. The market moves higher from there. The trade is a profitable trade with low risk. In trading, folks, if you want to care about something, care about technical analysis. Technical analysis defines your risk, limits your risk. It makes sure that you don't blow up. And that is what you should pay attention to as a retail trader. If you like this video, click the thumbs up. If you didn't like it, click the thumbs down. Put your comments in the bottom. It helps me. It helps us serve you better. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.